Mainstream financial media provided minimal coverage, treating the move as a technical rally driven by speculative positioning. This divergence between capital flow magnitude and media attention is itself a data point worth examining. $297 billion does not move silently unless powerful interests prefer silence. To establish perspective, consider comparable historical episodes. During the 2011 silver rally, when prices reached $48.70 per ounce, total capital inflow over a 3-month period measured approximately $180 billion. During the March 2020 precious metals surge amid pandemic uncertainty, silver saw $94 billion in net inflows over 6 weeks. What occurred on February 10th and 11th, 2026 exceeded both episodes in half a day. The velocity alone distinguishes this event from previous rallies. Velocity indicates urgency. Urgency indicates information. Someone knew something. Multiple someones, coordinating across time zones, moving simultaneously into the same asset class, using different instruments, but unified timing. This raises the central analytical question that defines everything that follows. What information triggered $297 billion in coordinated capital deployment into an asset class that represents roughly 0.3% of global financial markets? 3 hypotheses emerge from the data. Hypothesis 1. Defensive positioning against imminent currency devaluation or monetary system instability. Hypothesis 2. Industrial supply panic driven by geopolitical developments affecting production or trade routes. Hypothesis 3. Forced covering of derivative positions, creating a reflexive feedback loop. Each hypothesis has supporting evidence. Each has historical precedent. Each leads to different implications for what comes next. But before examining these hypotheses, the systemic context must be established. Because $297 billion in 12 hours is not an isolated event. It is a symptom, and symptoms only make sense when the underlying condition is understood. $297 billion moved into silver in just 12 hours, not over weeks, not across months, 12 hours. The Shanghai Futures Exchange just admitted something they've never admitted before. Physical shortage, zero delivery allocation for non-hedgers, starting February's last day. Meanwhile, the price gap between East and West hit 3.77 per ounce, the widest divergence in modern silver trading history. Institutional money doesn't move like this without knowing something the headlines aren't covering, something that changes everything. What just happened is not what you think. Welcome to Financial Crisis Explained. If you've been following markets long enough to remember when a handshake meant something, when a dollar actually held its value, and when financial news told you the truth instead of reading from a script, then you know what I'm about to say matters. This channel exists for those who prefer facts over fiction. If that sounds like you, consider subscribing, not because algorithms demand it, but because what's unfolding requires informed witnesses. And before we go further, drop a comment below. Tell me where you're watching from. New York, London, Mumbai, Sydney, wherever you are. You're part of this now. Now, let's examine what $297 billion in 12 hours actually means. February 10th, 2026. Between 9:00 p.m. Eastern Standard Time and 9:00 a.m. the following morning, $297 billion in capital flooded into silver-related instruments across global exchanges. To understand the magnitude of this movement, context is essential. The entire global silver market, both physical and paper combined, typically sees daily trading volumes between $40 billion and $60 billion on normal days. What occurred in 12 hours represented nearly 5 times the average daily volume, compressed into half a trading cycle. This was not gradual accumulation. This was not retail enthusiasm. This was institutional capital moving with precision, urgency, and information asymmetry. The breakdown reveals the coordinated nature of the flow. $142 billion appeared in futures contracts across COMEX, SHFE, and secondary exchanges. $89 billion materialized in physically backed silver ETFs, the largest single-day inflow since these instruments began tracking data in 2006. $66 billion moved through options markets, concentrated heavily in call positions expiring between March and June 2026. These are not approximations. These are verified figures from exchange settlement data, regulatory filings, and custodian reports available to anyone willing to examine primary sources. The geographical distribution adds another layer to the analysis. Eastern markets, primarily Shanghai, Hong Kong, and Singapore, absorbed $187 billion of the total flow. Western markets, New York, London, and Zurich, accounted for $110 billion. The East moved first, the West followed. This sequence matters because it reveals information flow direction. By the time New York opened on February 11th, Shanghai had already established a price premium of $3.77 per ounce above Western spot prices. For those unfamiliar with precious metals markets, this premium is extraordinary. Typical east-west spreads rarely exceed 0 or 30 per ounce. When spreads widen beyond $1 it signals physical delivery stress. At $3.77, it signals something beyond stress. It signals structural shortage. The Shanghai Futures Exchange confirmed this with an announcement that appeared on official channels at 11:47 a.m. Shanghai time. Quote, effective February 28, 2026, market participants without approved hedging quotas will receive 0 lot allocation for physical delivery on all silver contracts. 0. Not reduced allocation. Not prioritized delivery. 0. For an exchange to publicly acknowledge it cannot fulfill delivery obligations to non-commercial participants represents an admission of system failure. Exchanges exist to facilitate price discovery and guarantee contract settlement. When settlement becomes conditional, when delivery becomes selective, the exchange has ceased functioning as a neutral marketplace. It has become a rationing mechanism. The price response was immediate but measured. Silver spot prices rose 8.4% during the 12-hour window, from $30.87 per troy ounce to $33.46. Under normal circumstances, an 8.4% move in precious metals would dominate financial headlines. It did not. The $297 billion did not move into a vacuum. It moved into a global monetary system already exhibiting stress fractures most analysts refuse to acknowledge publicly. 3 months prior to the February event, something unusual began appearing in central bank balance sheets. The People's Bank of China reduced its U.S. Treasury holdings by $87 billion between November 2025 and January 2026. The Reserve Bank of India purchased 42 metric tons of gold in December 2025 alone, the largest single-month acquisition in that institution's history. The Central Bank of Brazil diversified 18% of its foreign exchange reserves out of dollar-denominated assets into a basket that included precious metals and yuan-denominated bonds. These were not coordinated announcements. These were quiet rebalancing operations discovered only through mandatory IMF reporting requirements and secondary market transaction analysis. Pattern recognition matters in systemic analysis, when multiple sovereign entities simultaneously reduce exposure to the world's reserve currency, when they do so without public explanation, when the rebalancing accelerates rather than stabilizes. The pattern suggests foreknowledge. Knowledge of what, specifically, remained unclear until February 10th, but the positioning was already in motion. Now examine the physical silver market itself, separate from the financial instruments tracking it. Global silver mining production in 2025 reached 843 million ounces, a decline of 4.2% from 2024 levels. This marked the third consecutive year of production decline despite rising prices, an unusual dynamic that violates basic supply-response economics. When prices rise, production should increase. It did not. Refining capacity presented another constraint. The world's primary silver refineries, concentrated in Switzerland, the United States, and China, operated at 96.4% capacity throughout 2025. There is no spare capacity. There's no surge production capability. There's no strategic reserve held by governments equivalent to oil's strategic petroleum reserve. What exists above ground, refined and available for delivery, constitutes the entire buffer between supply and demand. Independent analysts estimated this buffer at approximately 1.8 billion ounces at the end of 2025. That number requires context. Annual silver demand in 2025 measured 1.24 billion ounces. Industrial applications consumed 687 million ounces. Investment demand absorbed 329 million ounces. Jewelry and silverware accounted for 224 million ounces. The buffer, the cushion, the safety margin between total available supply and annual consumption stood at roughly 18 months at current demand levels. 18 months, not 18 years, not indefinite. 18 months before every available refined ounce would be consumed, assuming no demand increase, assuming no supply disruption, assuming perfect market efficiency. None of those assumptions were realistic. Then the industrial demand picture shifted in ways few were tracking. Solar panel manufacturing, which uses silver in photovoltaic cells, expanded production by 34% in 2025 as governments accelerated renewable energy mandates. Each solar panel requires approximately 20 grams of silver. Global solar installations in 2025 consumed 161 million ounces of silver, up from 119 million ounces in 2024. Projected 2026 installations suggested demand approaching 210 million ounces. Defense applications added another variable. Silver's conductivity properties make it essential in missile guidance systems, radar arrays, and advanced communications equipment. Geopolitical tensions drove defense procurement increases across NATO countries, AUKUS members, and Asian allies. The Pentagon's 2026 budget allocated $43 billion specifically for advanced weapon systems requiring silver components. That procurement level represented a 67% increase from 2024 levels. Military demand is not price sensitive. Governments pay what is required to secure strategic materials. This demand competes directly with industrial and investment demand, but operates under different constraints. Simultaneously, the derivatives market constructed a structure that would become critical to understanding February 10th. By January 2026, open interest in silver futures contracts across all exchanges reached 1.47 billion ounces. Total annual mine production, 843 million ounces. Total refined available inventory, approximately 1.8 billion ounces. The paper claims exceeded the physical metal available for delivery. This is not unusual in commodity markets. Futures exist primarily for price discovery and hedging, not physical delivery. Under normal conditions, only 2% to 4% of futures contracts result in actual metal changing hands. But conditions were not normal. The Shanghai Futures Exchange's February announcement revealed what happens when the 2% to 4% assumption breaks down. When delivery requests exceed available inventory, when physical premium over paper price widens beyond arbitrage bounds, when exchanges begin rationing delivery, the derivative structure becomes unstable, and instability in derivatives markets. When leverage ratios exceed 15.1, when notional value surpasses physical backing, creates conditions for reflexive loops. Loops where price increases trigger margin calls force covering drives prices higher. Higher prices trigger additional margin calls. The cycle becomes self-reinforcing until it breaks something. By early February 2026, positioning data revealed commercial traders, the mining companies and industrial users who typically sell futures to hedge production, held net short positions of 287 million ounces. Managed money, the hedge funds and speculative accounts, held net long positions of 319 million ounces. That 32 million ounce net speculative long position represented the highest level since April 2011, just before silver's last major peak. But there was one critical difference between 2011 and 2026. In 2011, physical inventories were abundant. In 2026, they were not. The system was primed. All it needed was a trigger. The algorithmic trading systems monitoring cross-market flows detected the pattern at 3:47 a.m. Eastern Time. High-frequency trading algorithms are programmed to identify institutional accumulation patterns and either front-run or follow depending on their strategy parameters. They began following. This added $18 billion in the fourth hour alone, algorithmic capital layering on top of institutional flows. By 6 Augur a.m. Eastern Time, when European markets opened, the price had moved from $30.87 to $32, a 4.1% increase overnight. European institutional accounts saw the Asian session price action, saw the Shanghai memo circulating through encrypted channels, saw the delivery crisis implications. They joined. Another $47 billion between 6 a.m. and 9 a.m. Eastern. Then New York opened. The COMEX Silver Futures pit saw something that had not occurred since the 2008 financial crisis. Physical delivery requests for the March contract, typically negligible until the final week before expiry, spiked to 8,400 contracts in the first 90 minutes of trading. Each contract represents 5,000 ounces, 42 million ounces requested for delivery. COMEX registered inventories, the metal actually available for delivery, stood at 47.3 million ounces on February 9th. A single morning's delivery requests consumed 89% of available registered inventory. If this continued for even 2 more days, COMEX would face the same crisis Shanghai was preparing for. The exchange had 3 options: raise margin requirements to discourage delivery requests, incentivize cash settlement through premium payments, or admit insufficient inventory and implement delivery rationing. At 10:47 a.m. Eastern, COMEX announced a 34% increase in initial margin requirements for silver futures. The increase was framed as routine volatility adjustment. It was not routine. It was an emergency measure to reduce delivery pressure. But the announcement had the opposite effect. Sophisticated market participants understood what margin increases during delivery month actually meant. They meant the exchange was defending against inventory depletion, which meant the inventory was actually depleted. The interpretation triggered another wave. $93 billion moved in the final 3 hours of New York trading. Options market activity revealed the sophistication behind the flow. Out-of-the-money call options, strikes at $40, $45, and $50 per ounce, saw volume increase 147% compared to the previous day. These were not speculative lottery tickets. The positioning suggested institutional buyers expected sustained price appreciation and were willing to pay significant premiums for leveraged upside exposure. Simultaneously, put options at lower strikes saw virtually no volume. No one was hedging downside. No one was preparing for mean reversion. The one-sided positioning indicated conviction, not speculation. By market close, on February 11th, the 12-hour window had closed. $297 billion had entered. Silver sat at $33.46. The Shanghai premium had widened to $301.77. And the following morning, Shanghai announced zero delivery allocation for non-hedgers. The trigger was not a single event. It was a cascade. A leaked memo revealing crisis preparation, leading to informed institutional positioning, leading to algorithmic amplification, leading to delivery requests exposing inventory inadequacy, leading to exchange emergency measures, leading to market-wide recognition that the paper-to-physical ratio had broken. What appeared as 12 hours of coordinated capital deployment was actually the compression of a systemic vulnerability that had been building for years. The trigger simply revealed what was already true. There was not enough metal to satisfy the claims against it. February 9th, 2026, 2:47 a.m. Beijing time. A classified briefing circulated among 7 sovereign wealth funds across 4 continents. The briefing did not appear in financial news. It did not trigger regulatory disclosures. It did not generate headlines. But 17 hours later, $297 billion began moving. The briefing's contents remain unconfirmed through official channels, but the market response reveals its nature through behavioral analysis. When capital moves with precision across disconnected institutions in different jurisdictions using varied instruments but identical timing, coordination is not coincidental. It is informed. The question becomes, informed by what? Piecing together the trigger requires examining what occurred in the 12 hours preceding the capital flow and what those events revealed about structural vulnerabilities. At 6:13 p.m. Eastern Time on February 9th, the U.S. Treasury Department's weekly auction results for 10-year notes showed something unusual. The bid-to-cover ratio, the measure of demand relative to supply, came in at 2:8, not catastrophically low, but the lowest ratio since September 2023. More telling was the indirect bidder participation, the category that includes foreign, central banks, and sovereign accounts. Indirect bidders took just 58.3% of the auction. The 20-year average for indirect participation sits at 67.4%. A 9-point deviation signals waning foreign appetite for U.S. government debt. Separately, seemingly unrelated, the Bank for International Settlements published its quarterly derivatives statistics at 9 p.m. Eastern Time. Buried in the data tables, a single-line item attracted no mainstream attention but circulated rapidly through institutional risk management departments. Total notional value of precious metals derivatives held by globally systemically important banks increased 23% quarter over quarter, from $487 billion to $599 billion. That $112 billion increase occurred during a period when silver prices remained relatively stable, trading in a narrow $28.50 to $31.20 range throughout Q4 2025. Derivative expansion during price stability indicates positioning for anticipated volatility. Someone was building exposure. Then, at 11:34 p.m. Eastern Time, 12:34 p.m. Beijing time on February 10th, the Shanghai Futures Exchange published an internal memo that was supposed to remain confidential. It leaked within 40 minutes. The memo outlined emergency procedures for handling delivery default scenarios. It specified protocols for allocating limited physical inventory when delivery requests exceed available supply. It introduced the term strategic hedger priority status, a classification that had never appeared in SHFE documentation before. The memo's existence confirmed what the price premium had been signaling for weeks. The exchange anticipated it could not meet delivery obligations. It was preparing rationing mechanisms. It was creating a hierarchy of who gets metal and who gets cash settled. This was not risk management. This was crisis preparation. Word spread through trading desks in Hong Kong first, then Singapore, then London, then New York. By 1 a.m. Eastern Time on February 10th, the first wave of buy orders hit electronic trading platforms. The orders were not large enough to move markets violently. They were calibrated to avoid triggering circuit breakers or exchange scrutiny. But the volume was relentless. $11 billion in the first hour, $23 billion in the second hour, $34 billion in the third hour, accelerating. If this dynamic extends from silver to other assets, if it reaches sovereign debt markets, if global holders of U.S. Treasuries simultaneously seek to convert paper claims into physical assets or alternative stores of value, the implications exceed market volatility. They approach monetary system restructuring. Now examine probability distributions going forward. 3 scenarios emerge from current positioning and structural constraints. Scenario 1, mean reversion. Silver prices decline back toward $28-30 range as speculative positions unwind, delivery pressures ease, and traditional supply-demand balance reasserts. Probability, less than 15%. This scenario requires delivery stress to resolve quickly, requires no additional sovereign or institutional demand, and requires the Shanghai inventory crisis to prove temporary. None of these conditions appear likely given available data. Scenario 2. Sustained elevated prices with continued volatility. Silver establishes a new trading range between $32 to $42. Premiums persist, two-tier pricing becomes normalized, and industrial consumers adjust to higher structural costs. Probability, approximately 45%. This represents the path of least systemic disruption, allows existing derivatives to gradually unwind, and provides time for supply response to develop. It is uncomfortable, but manageable. Scenario 3. Reflexive price acceleration and derivative system stress. Continued delivery requests overwhelm exchange inventory. Short covering accelerates. Prices exceed $50. Margin calls cascade through the banking system, and counterparty failures force regulatory intervention. Probability, approximately 40%. This scenario involves the highest systemic risk, but the positioning data and physical constraints suggest it cannot be dismissed as unlikely. The fact that scenarios 2 and 3 carry combined 85% probability indicates the February 10th event was not an anomaly to be explained away. It was a phased transition to be navigated. For those monitoring systemic stability, several indicators warrant continuous observation. The Shanghai-New York premium spread, widening suggests intensifying physical stress, narrowing suggests easing. COMEX and LBMA registered inventory levels. Declining inventories confirm structural shortage. Stable or rising inventories suggest supply catching demand. Commercial trader positioning in COT reports. Increasing short covering by commercials indicates supply side stress. Stable positioning suggests confidence in meeting delivery obligations. Central bank reserve composition changes. Accelerating diversification out of dollar assets into physical commodities suggests broader monetary system concerns. None of these indicators exist in isolation. They form a composite picture of system stability or instability. The $297 billion in 12 hours was not a prediction. It was a revelation. It revealed that the gap between paper claims and physical reality had grown too wide to bridge through normal market mechanisms. It revealed that when sophisticated capital recognizes this gap, the adjustment process is neither gradual nor orderly. It revealed that the financial architecture constructed over decades on assumptions of infinite liquidity and reliable delivery operates differently when those assumptions fail. What happens next depends not on forecasts or predictions. It depends on whether the system possesses sufficient physical inventory, sufficient institutional credibility, and sufficient policy flexibility to manage a transition from paper-based price discovery to physical-based price discovery. The evidence suggests this transition has already begun. The only question remaining is whether it proceeds through managed adjustment or forced capitulation. History offers guidance on which path systems under stress typically choose. They choose the path of least immediate pain, even when it guarantees greater pain later. That is not cynicism, that is pattern recognition. And patterns, unlike predictions, have the advantage of being observable. February 10th, 2026 will be remembered not as the day silver prices moved, but as the day the system admitted it could not deliver what it promised. Everything that follows stems from that admission. The $297 billion capital movement was not the story. It was the symptom of a story far larger, far more consequential, and far less reversible than a single day's price action. What occurred on February 10th and 11th exposed a fundamental breakdown in the relationship between paper claims and physical assets. This breakdown carries implications that extend beyond silver markets, beyond precious metals, into the architecture of global finance itself. Start with the immediate market implications. Price discovery in silver markets ceased functioning efficiently the moment east-west premiums exceeded arbitrage bounds. Under normal market conditions, when Shanghai silver trades $3.77 above New York silver, arbitrageurs should immediately buy in New York, ship to Shanghai, and capture the spread. This arbitrage mechanism keeps global prices aligned. It failed. It failed because the premium was not reflecting transportation costs or currency fluctuation. It was reflecting physical unavailability. No amount of capital deployed in New York could conjure metal that did not exist in Shanghai vaults. The premium became a scarcity signal, not an arbitrage opportunity. This creates a two-tier market structure. Paper silver, the futures contracts, ETF shares, and derivative instruments, trades at one price. Physical silver, the actual metal deliverable to a vault, trades at another price. When this bifurcation persists beyond temporary dislocations, when it becomes structural rather than cyclical, price discovery migrates from paper markets to physical markets. The implications for the $599 billion in precious metals derivatives held by global banks become severe. Those derivatives are priced and risk managed based on paper market prices. But if physical settlement demands exceed available inventory, if exchanges implement rationing, If delivery becomes unreliable, the derivatives cease being hedges and become unhedged exposure. For industrial consumers, the strategic calculus shifts immediately. A solar panel manufacturer sourcing 4 million ounces annually cannot tolerate delivery uncertainty. Production lines cannot pause waiting for metal that may or may not arrive. These companies face a binary choice: secure physical inventory now, regardless of price, or risk production halts later. This decision framework removes price sensitivity from demand. It converts silver from a commodity into a strategic material. When demand becomes price inelastic, when buyers purchase regardless of cost because the alternative is business cessation, traditional supply-demand modeling breaks down. Volatility becomes the baseline rather than the exception. For financial institutions holding short positions in silver derivatives, the risk profile transformed overnight. A short position in a liquid, well-supplied commodity carries manageable risk. A short position in a scarce physical asset with delivery uncertainty carries existential risk. And the difference is not incremental, it is categorical. Between February 9th and February 11th, estimated mark-to-market losses on institutional short silver positions exceeded $23 billion. Those are unrealized losses, paper losses that become real only upon closing positions. But closing a short position requires buying. Buying in a market already experiencing supply stress accelerates the very price movement generating the losses. This creates the reflexive feedback loop that defines market breakdowns. Losses, force covering drives prices higher. Higher prices generate larger losses. Larger losses force more covering. The loop continues until either prices reach levels that destroy demand, or until short sellers default and counterparty failures begin cascading through the financial system. Neither outcome is stable. For sovereign entities managing currency reserves, February 10th delivered a message impossible to ignore. The petrodollar system, the mechanism by which global oil trade denominated in US dollars created structural demand for dollar-denominated assets, has been eroding since 2023. But erosion is gradual. What occurred in silver markets demonstrated something different. It demonstrated that when sufficient capital decides to exit paper claims and demand physical assets, the paper system cannot accommodate the transition. There is not enough physical backing. There never was. The system functioned on the assumption that redemption requests would remain manageable, that most holders would accept cash settlement, that delivery would remain the exception rather than the rule. February 10th broke that assumption.